Welcome to the Young Money Diet podcast. And today we will be talking about RRSPs or Registered Retirement Savings Programs. But first, let's talk about a hot take. I think for most meals, the default option should be to eat it in bowls over plates. So I understand there are some nuanced meals like tacos or steak that you might have to cut into it, but bowls you should have a lot more of than plates, and you should go to that more often than not.
I do not agree, but I guess it would have to. I'm just thinking of my bowls I have in my house, and they're so small. So like, if you had something like a large tortilla and you're trying to make a wrap, how are you gonna wrap it up on the bowl? It's not gonna fit. Like lay flat out to prepare it.
Yeah, so I would just have it prepared on like a chopping board or something, and then just bring it to a bowl. Or, you know what? I guess we can get into the nitty gritty, but that's my hot take, and that's what it's called hot because I just don't see the utility of plates. Okay. Anyways, so let's start talking about RRSP. So like I said, it just means like registered retirement savings plan, and the easiest way I can explain it is it's just basically a tax advantaged or an income tax deferred savings account. So what that allows you to do is essentially if you move your money into that account, it's a savings account and it makes sure it doesn't get counted towards your taxable income. When I say taxable income, it's just specifically about income tax that we're talking about, where the advantage carries through in an RRSP. So the easiest way to think about it is basically the government's trying to encourage you to start like saving up for your retirement, and they're saying, hey, don't worry about taxes for this amount of money this year that you've put away. We can worry about this in 30 or 40 years whenever you choose to retire based on your age. So really simply, who can open an RRSP account? You have to have Canadian tax dealings. So i.e. you could be a citizen, permanent resident, whatever. If you file taxes in Canada, that has to be a prerequisite for you to open an RRSP. You have to be between the ages of 18 to 71. Those are the times when you can have your RRSP. If you're younger than 18 with your parents' permission or your guardians, you can also open an RRSP account with any financial institution. So a simple rule of thumb is RRSP is where money should go into and not come out until you are ready to retire, with two caveats that we'll mention. There's really two really cool uses of RRSPs with respect to education and buying your first home that we can get into a little bit later. Why would we want to look into RRSP? So it's kind of simple. Really, it's one of the things is self-control is overrated. So once you put money into RRSPs towards your retirement, you don't really have to worry about it because it's very restrictive in terms of taking money out. So you can just like let it grow there over time without having to pay any capital gains tax and just wait till you retire, and then you would just essentially pay income tax at that time. Speaking of that, your likelihood of your taxes at that point when you're retired to be lower than your current rate is also really high, which makes sense to make sure your taxable income, you can lower it today. And you can also start planning for your pension and your future at the same time and make sure you pay taxes when you withdraw money on that end. And then essentially it's something Raj is going to touch on. A lot of employers, specifically if you are a permanent full-time staff, they sometimes have incentives like a registered pension plan that Raj will mention over time that is very beneficial to use, and that gets counted towards your RRSP. So Raj, how do we get started? What are our contribution limits? Walk us through it.
Yeah, for sure. So like Wasif mentioned, the RRSP is really for the government to incentivize individuals to put money away for future retirement, as well as defer your taxes. So presumably when you retire, you have less expenses and you can withdraw less money and have a lower income and pay a lower tax bracket. And so that's the big incentive for the RRSP, aside from some of the unique features that Wasif is going to mention. But in terms of how to get started, there's so many different resources out there. I personally started my RRSP with Bank of Montreal when I was young. My parents started it for me. And since then, I have explored many different banks, Toronto Dominion, RBC, and now I've landed in Questrade. But really, a lot of the RRSP bank accounts are very similar in their products and services and what they offer. One thing I will mention is it's important to be very clear on what type of account you want. And there's ultimately two. There's a self-directed account, and then there's what I call the handcuffed account. But I mean, it's really just to have an account that you can buy the product and services of that bank. So predominantly mutual funds or GICs or CDs, whatever they might offer. So for me personally, and what I recommend to other individuals is to go with the self-directed, because you can still buy those terrible mutual fund products if that's what you're inclined to do. Ultimately, I mean, we'll have a whole nother segment talking about investment strategies and products and comparing what is out there. But that's kind of a plug hot take for me. So I'm going to just jump into an example. So let me share my screen here.
So for our podcast listeners, again, this is going to be a little bit unfortunate that it is a visual medium. We'll try to talk you through it so you're able to understand what's happening. But if you have access to YouTube, that would be fantastic for this episode. So you can tune in and see what we're talking about.
Yeah. So I'll try to walk through it just verbally as well as I'm going through this example. But as you can see on the screen here, we've got Fido the fish. And Fido the fish makes $50,000 a year before taxes. So this is what we call gross income. So the reason we're choosing $50,000 is just for pure simplicity of the math. And I'm assuming that Fido's tax rate is 25%. And now there's combined, that I'm assuming combined federal and provincial taxes. So taxes is another episode that Wasif and I have pondered and we will likely feature in the future. But for simplicity, let's presume that Fido is paying 25% taxes. So what does that mean? That means throughout 2020, Fido has paid $12,500 in taxes. And what the government does, because people are irrational, they withhold those taxes through your employer throughout the year. So when it comes time for tax season, you've actually already paid predominantly most of the taxes. And if you overpay, then you might get some money back in a tax refund. And if you underpay, then you will owe the difference. But for this example, let's say Fido's employer had it bang on and they've paid exactly $12,500, which is 25% of their income. So their net income now is $37,500. So where the RRSP comes into play, your contribution limit is 18% of your gross income or a maximum of $27,230, whichever is lower. So for Fido, 18% of $50,000 is $9,000. That's this in blue. So what does that mean? That means Fido can contribute $9,000 into his or her RRSP. Let's presume that Fido has $5,000 that they want to contribute to their RRSP for the year. This would mean that their updated gross income, as per the eyes of the CRA, is $45,000. So how did I get that value? You get your gross income of $50,000 or whatever you make, and you can deduct however much you've contributed to an RRSP. So we've deducted $5,000. And in terms of the CRA's eyes now, we've only made $45,000. So our taxes, if we had only made $45,000, is $11,250. So you can see we've paid $12,500, but now that we've deducted our income, we only actually owe $11,250. So that gives a tax refund to Fido of $1,250. So it doesn't mean they've saved that money in tax. It means that at a later time when Fido retires, he or she can pull that $5,000 out and pay taxes on that at that time. But let's say that their tax rate is maybe only 15% or 10%. Instead of 25%. Yeah. Exactly. So you could see as your income grows higher and higher and your tax rate is higher, it's more beneficial to put this money away in an RRSP. So the next thing I want to talk about is I mentioned that Fido's contribution limit is $9,000, but they've only allocated $5,000. So what about that extra $4,000? What does that mean? They haven't used that room. Did they lose that room? The answer is no. The nice thing with the RRSP is that value carries into the future. So let's presume that Fido for the following year makes another $50,000, exactly the same. That means they can contribute 18% of that to their RRSP. So This $9,000 is from their new income, and that $4,000 that they did not use and take advantage of last year carries forward into their future years. So their total contribution for the following year would be $13,000. And it goes in perpetuity, meaning it can, if they don't use it again, and let's say they make another $50,000, they don't put any money in this year, they would add another $9,000 to this, etc., etc. So
Yeah.
when they're maybe older and making $100,000, they have a lot more room that they can contribute to and defer some of their taxes and really take off that top part of their income, the top maximum tax bracket.
Yeah, that makes sense, actually. So basically, the larger trend here is, if you're making income and you continue to work, which is most people, until, you're of the age of retirement, you'll just have a lot more cap available for you to dump on money into on your RRSPs over time. So, like, let's say you're a responsible person, you've been doing that from ages 25 to 65 or whatever, you're ready to retire. Let's talk about the fun stuff, which is how do you withdraw money out of your RRSP? So for the purpose of the example, we'll just say a mature RRSP is basically from age 55 and on. So someone who's looking to retire from the age of 55 to up to whenever. So for that, they really only have 3 options for you to start withdrawing money out of your RRSP. So option number 1 is you take a lump sum withdrawal payment. So for example, if you saved and your money grew to be $1 million over time, once you start withdrawing that money goes straight to your bank account. There is a withholding done by your financial institution. Very simply put, very similar to your employer. You know how they withhold your taxes, Raj, withhold mine. Your financial institution will withhold a portion of your tax. And then also, you would have to file that as your income. So for you to take a lump sum payment, your income for that year will be massive because you'll just make $1 million per year and pay an enormous amount of money in taxes. So obviously that's an ill-advised route. Very, very quickly in terms of tax withholding percentages. So every province in Canada outside of Quebec, it's just from $5,000 and down, they withhold 10%, $5,000 to $15,000, they withhold 20%, $15,000 and up, they withhold 30%. Just a general rule of thumb. And in Quebec, the percentages are 21, 26, and 31% respectively. So basically, that's your lump sum option. The second one's the most common, which you alluded to, Raj, which you just turn your RRSP account into an RRIF, which is a registered retirement income fund. And what that allows you to do is rather than taking $1 million in 1 year, you just take $1 million over 30 years. So you take 50,000, 50,000, 50,000 every single year, which means your tax hits are a lot more reasonable because you're only paying tax on the $50,000 worth of income that you've had that year. That's by far the most common option that people choose to go with. And by age of 71, all your RRSP has to be converted into an RRIF or otherwise, because after 71 you just simply are not allowed to hold an RRSP account. And the third option is just called annuities, and what that means is you can talk to a financial institution, give them a certain amount of money from your RRSP to them, and they guarantee every month or every year some amount of money is going, a predetermined amount is going into your account. And that just gives you a peace of mind, make sure you don't have to worry about doing the math or whatever. So then there's no withholding of taxes, you just have to report that as your income, exactly like you've been doing all your life when you're just making money from an employer. They're just taking care of that money and just giving you an annuity every single year. So that's basically the withdrawal. And then there's 2 sort of caveats. So the 2 caveats I want to mention is there's 2 cool use cases for an RRSP withdrawal that doesn't take an income tax hit. One of them is called the home buyers plan, and then the other one's called lifelong learners plan. So home buyers plan, very simply put, allows you to take up to $35,000 from your RRSP and put it towards the down payment of a potential home you're looking to buy. Generally, it's really meant for first-time home buyers, so people who are going to use that as their primary residence, and someone who hasn't owned a property in the last 4 calendar years. Generally, those are the criteria where you can get eligible for that, and you can take up to a $35,000 amount from your RRSP and put that towards your down payment. So the only catch that is you have to pay that money back within 15 years into your RRSP. So if you took $35,000 out, you have 15 years to put $35,000 back in, and there is no income tax implications going either way. So lifelong learners plan is very, very similar to that, which is you can take up to 20,000 Canadian dollars out of your RRSP over a 4-year period. So you can, with a maximum of $10,000 per year. So basically, if you're going to full-time student in an educational institution and you have a program that falls within that category, then you can take money out of your RRSP to pay your tuition. So basically, you can take up to 20,000 over a 4-year period of time. The caveat to that is you have to, again, make it whole or make it net zero. You just have 10 years to pay that back instead of 15, 1-5, like the home buyers plan, Raj.
Yeah.
So those, I think, are very, very two cool uses, and we can try taking advantage of that. I know you've took advantage of the home buyers plan yourself, Raj.
Yeah,
right?
so I encourage individuals to look into the home buyers program, especially for the younger folks that have been diligent and putting money into their RRSP. They can now take that money and use it for utility to put on their down payment, but you do have to pay yourself back that money over that 10 to 15 years time limit. So one thing I wanted to talk about is just, okay, you've put money into your RRSP. What exactly can you do with it in terms of investments? So we talked about this briefly in the TFSA podcast, and we're going to have an investment podcast on its own episode. But very simply put, you can do the same kind of things that you could do within your TFSA to some extent. You could leave it in cash, you could buy bonds, you could buy stocks, you can buy real estate investment trusts, you can buy different mutual funds. One thing, now getting into my personal preferences with the RRSP, that's worth considering or thinking about if you're listening to this podcast. So if I go back to Fido the Fish, who has $9,000 available to put into their TFSA, well, they're only getting taxed at the $50,000 tax bracket. Personally, if Fido is very meticulous and strategic with his or her money, I would say it's better off to carry that contribution until they're middle age and making, let's say, $100,000, because you're paying a much higher tax on that $9,000. So we use 25% as an example for their tax rate. Maybe now they're paying 33 or 35%. They're going to have a lot more savings by putting that allocation into their RSP a lot later. However, to backpedal on my recommendation there, if you're the type of person that is very ill-equipped to manage your own money, or if you've got money, you're impulsive and you're going to spend it. Oh, I've got $9,000. I should go buy whatever, a Peloton. Then it's a great avenue to put that money away and put it into something that is very restricting, that is going to encourage you to leave it there and take it out when you need it, which is the intent of the name, right? When you're going to use it for retirement.
RRSP. Yeah, no, I love that. So I want to echo it, and I just want to, I guess, put my thoughts in, and then we can close off the episode here. So I like exactly what you said, Raj, and my order is very simple for our folks that are listeners. If you are, a permanent or a full-time employee, and you have the advantage or opportunity to have an employer match fund through your account, make sure you take advantage of that, because it's basically usually up to a certain percent cap that they will give you some free money. So for example, if it's 5% of your income, then your employer will match 5%. Great. Start there. That's the easiest way to do it. Take advantage of that. Then we would like to say, contribute towards your tax-free savings account. So TFSA, you can revisit that episode if you need a little bit of a refresher. But if you want to put all your money that you have additional and save that way, it's really flexible. So you can use that as your emergency fund. You can use that, if unexpected expenses come up in your personal life. So that's where I would recommend. Anything after is exactly go with Raj's advice in terms of, you can start thinking into more nuances of how to use your RSP. Perhaps you want to double down mortgage payments, or, there's many other ways you can use that. But if you're in that situation, you're in a very, very good shape. You potentially don't even need our advice at that point, is the way I put it, Raj.
Hey, everybody can learn from everybody.
Yeah, that's actually a very, very good point. And we learned a lot, researching for this episode ourselves too, Raj. So I think that's good thinking. But yeah, that's really all we have today. And then, Raj and I are available for, if you guys have any questions, leave comments in the YouTube video, or just reach out to us if you know us personally. And always to remember to stay hungry.
And stay humble. But one thing I want to mention before we close off, is that Wasif and I have just scratched the surface on the RRSP. If you have any questions, please reach out. Especially when it comes to taxation, a lot of people get into the weeds there. There are a lot more nuances and rules within the RSP. We've just given a very simplistic, high-level overview, which will cover 95% of cases of people listening out there. But that's all I wanted to end off with. So sorry to break our scheme of events there.
No, that's okay, everyone. Break a leg, make contributions towards your RSP, and then we'll see you in the next episode. Bye.